Yo, yo, yo. CPA Strength here, back again with another video. Great accounting video here. We are on Accounting for Beginners 142, all right? Over here, we've got the best playlist, the best accounting playlist you're gonna find. Could you please like the video? Leave a comment for the algorithm, please. Just say anything in the comments. Say anything, I don't care. Say anything. If you like the content, think about subscribing. I will be sending a cookie out to anybody who does any of those. I am CPA Strength because I am the strongest licensed CPA in the state of Florida. Possibly the Southeast, possibly the US, who knows, let's go. So this is 142. If you're new here, welcome. If you've been around for a while, thank you for sticking around. I hope I've helped you a lot. Kind of started this year with Accounting for Beginners 140. 140 was debits and credits. 141 was assets, draw, distributions or dividends, and expenses, and we talked about those. 142, we're going to talk about liabilities, equity, and revenue. That's what we're going to talk about in 142. Let's get into this. DC ADLER. Debits on the left, credits on the right. Debits on the left, credits on the right. Inherently, debit is not good or bad, it just is. A credit is not good or bad, it just is. And a debit and a credit will always equal. Always equal. Debits and credits always equal. So whatever you have on the debit side and the left hand side will always equal credit on the right hand side. That's DC. AID is assets, draw, distribution, dividends, a bunch of the D's here. Draw, distribution, dividend, owner's draw, shareholder distribution, dividend. And E, expenses. If assets are going up in value, you debit. If draw, distribution, or dividend is going up in value, you debit it. If expenses are going up in value, you debit it. We're not really talking about all that. Sorry for the long-windedness. We are talking about today, LER. We are talking about the credit side positives. We are talking about a liability, equity, and revenue. All three of those. If a liability is going up in value, you credit it. If equity is going up in value, you credit it. If revenue is going up in value, you credit it. I'm gonna work from bottom to top here. So with revenue, that's what I think revenue is when you've got money coming in. You know, you've got money coming in your business. If it's your ordinary income from doing ordinary activities, I would say is revenue. So you've got money coming into your business, I would say, I don't know, 80-90% of the time, if you've got money coming into your business, if you got money coming in, it's gonna be revenue. You know, whether you sell products or services, if you what would another reason why money would be coming in to your business if it wasn't revenue? It's gonna be kind of rare. You might have money coming in if someone's loaning you money. That might be a reason why you would have money coming in. If someone's loaning you money, that wouldn't be revenue. But how many times does someone loan you money? Not that, you know, a couple times a year really. And why else would you have money coming into your business? Might be person owning the business, sending money, his own money to the business, which would be like a reverse shareholder distribution. You know, if there's no money in the business. Or that could be a loan from shareholder to have money come into the business. But money coming into your business mostly, you know, if you're doing bookkeeping, you kind of gotta know. But if you're on a test and you see money coming in, I would say mostly that's probably gonna be revenue. But you know, do you have to pay it back to anybody, or why are you getting the money? You're getting the money like, okay, I do bookkeeping, so someone pays me for bookkeeping. That's my ordinary activity. Someone pays me for a tax return. That's my ordinary activity. If you get money coming in That's going to be a credit. You're going to credit that as a service revenue. That's going to be a credit. 99% of the time, service revenue is going to be a credit. You're not going to have really a debit revenue. I mean, that would be like you paying somebody back. You got money coming out of your business and it's revenue. It's like you're paying someone back. You don't really do that for the work. I would say mostly revenue is going to be a credit. If your revenue is going up, you credit it. If you get money, you know, that would be a debit cash because your cash is going up, and then you got it in the ordinary workings of your business. It's going to be a revenue going up. Credit that. You're going to credit. Revenue is going to be a credit mostly all the time. We go to equity. Now you're kind of in luck. You are not really going to be doing anything with equity because mostly it is the retained earnings. You don't really do that. You don't really add in the retained earnings. It's after the year rolls around. I have some videos on retained earnings. So you're not really going to mess with equity that much in journal entries. You might add a stock. Equity is a draw, distribution, or dividend. It lessens lessen the equity. But you're not really going to have too many journal entries to say, like, if you're, you know what I'm saying, if you're doing a journal entry or you're doing bookkeeping or you got a test and they say, hey, what's the journal entry? I would say you're not really going to have really many equities going up on the credit side. You might have an equity on the debit side labeled as a shareholder distribution or a dividend, but you're not going to have many equities that are going up in value. Which leaves us to liabilities. Now I would say on the credit side, liabilities are going to be, you're going to have, you know, if a liability is going up in value, you're going to credit it. If a liability is going down in value, you're going to debit it. Meaning, let's say you get a loan from your mom. Let's say you get a loan from mom. Remember how you were texting her about how debits equal credits before? And she was like, wow, you're really doing good out there. I know you need money. I'm gonna loan you money. You have to pay me the money back. So let's say you get a loan from mom. So you get money, you get 500 bucks from mom, but you got to pay her back. So that would be liability account increasing because you have liabilities from 0 to 500. So you have liabilities increasing. So that would be a credit. But now let's say you pay mom back. Let's say you pay her that $500 back. That means you did owe her $500, but now you don't owe her. Now you owe her nothing. So your liability account went from, or your loan from mom account under liabilities went from 500 to 0. So it went down. So if it goes down, it's the opposite. So if it goes down, it would be a debit. If it goes down. And we have the opposites of, if a liability, equity, or revenue is going up in value, you credit it. If they're going down in value, you debit it. Same with assets, draw, distribution, dividends, and expenses. If they're going up in value, you debit it. If they're going down in value, you credit it. So it's like a mirror. It's basically a simplified T account, but it's way more. I'm going to show you way more. What else would a liability be besides a loan from somebody? A loan from somebody. If you get a loan from your mom, you have to pay her back, so you're liable for that. I always like to do, because you might say, you got a loan from this corporation, blah blah blah, for $869,000 billion. And I don't know. What helped me when I was studying before was I would try to break it down like more simply, I guess, and be like, instead of corporation XYZ, you know, Megalacorp 28,400,000,000, I would say I got a loan from mom for $500, or I got a loan from mom for $50. You're liable for that. You owe them back. Also, a lot of liabilities are payables, accounts payable, wages payable. Pretty much, mostly all the liabilities are going to be payables. I believe unearned revenue is a payable, but we're not going to worry about that right now. I mean, unearned revenue is a liability, but we're not going to worry too much about that right now. We're going to keep on going here. Let's get into why I really love the DC ADLER model, okay? DC ADLER breaks it in between debit and credit. So that's on the macro thing. Every transaction you have is going to be a debit or a credit. And I like it when that is kind of split off in its own little thing, like DC. It's its own thing, because I want you to know, at least if you say DC ADLER, DC, debit, credit, at least you'll always know the debit's on the left, credit's on the right, so you'll be doing decently at that. So that breaks those two up, which is very important. I went through so many years I probably had an accounting degree. I didn't realize that every transaction was going to be a debit or a credit or whatever. I don't know. Also, let's go down to expenses and revenue. The way I have ADLER, the way it's set up here, the way it is set up in the 6 different boxes. 6 different boxes. If you can't remember what's on the income statement, the income statement is down here at the bottom. An income statement is simply revenue minus expenses. So that's the income statement down here. I think that's pretty cool. We've also got balance sheet. What's a balance sheet? We haven't gone over the balance sheet, but it's the balance sheet, and the balance sheet is like the big financial statements, the big dog, all right? It's also the basic accounting equation, but it's the big dog. It is assets equals liabilities plus equity. That's the balance sheet. You have a bunch of assets, you have a bunch of cash in there. Do you owe it to somebody, or is it yours? You are just beginning or whatever. You can't recall really what's on the balance sheet or what's on the income statement. Everything is confusing. That's why I always say, just write out DC ADLER, and then, okay, you've got that. Take a breath of relief, a sigh of relief, and then you can do assets. Do one of these however you can remember it. Do assets, distribution, expenses, liability, equity, revenue, debit, credit. So you write all this down. Now you've got that. Then you're like, what? Then you circle this, and you circle this, and you say that's the income statement. Okay, cool. Look, that's the balance sheet. That's why I like to do DC ADLER, because it all matches up. It all matches up good. These 6 boxes match up with each other well. And debits and credits, DC's up by its own. That's the balance sheet. What else we got here? Because look, what is the balance sheet? Assets equal liabilities plus equity. There's the balance sheet. And what's the draw, distribution, or dividend? It's a reduction of equity. It's actually equity. So you got your balance sheet. You got your income statement. You are GTG, what? Good to go. Another reason why I like how this lines up. Assets and liabilities are kind of, opposites. In my opinion, like you got a lot of, in assets, you got accounts receivable. Accounts receivable. I always say don't abbreviate, don't be lazy, but y'all be making fun of me because I can't never remember how to spell receivable. So you got accounts receivable, meaning, people owe you money. And then kind of the opposite of that is accounts payable, where you owe somebody money. You've got a loan from mom on a liability side, and you would have a loan to mom on the asset side. Because if you loan somebody money, that's an asset, because they would have to pay you back, and you got money coming back. So the assets and the liabilities are, they work well together. So I like them right up here next to each other. I think it's obvious why I like the expenses and the revenue to be lined up together, and the equity lined up with your shareholder distributions or your owner's draw or your dividends on the other side of that, because they reduce the equity. Also, I'm thinking I want to touch on something else before we leave here. Give yourself a shout out if you're still here. Yeah, give yourself a shout out, bro. Trying to learn something, you have the attention span of more than 1 minute, give yourself some credit, because I can almost guarantee you a half an hour watching this video or whatever is going to be, you're going to go to class and you're going to know stuff it's going to be worth hours and hours and hours of lecture. Or learning the DC ADLER like this. Like, this is going to help you from day one to being a CPA. Like the whole gamut, which is crazy. So as I said before, you are analyzing a transaction. Something happens in your business. You've got a test question for school. I've also been getting a lot of comments that people are going to interview, brushing up on their interviews, watching my videos. So it's just so crazy that little 8 letters could just run the gamut. Also worldwide too, this is good information. So you have something that happened. Something would happen. You got money, you spent money, you got a loan, you got a receivable, whatever happened in your business. Now you're trying to analyze it. I guess you're gonna make a journal entry, whether you kind of know it or not. You're making a journal entry. It's gonna be one. It's gonna be one of 5. It's gonna go in one of 5 boxes, and you would find these boxes in the chart of account. Box 1 would be your assets. Box 2, liabilities. Box 2 would be a liability. This is crazy, because there's no box 3 would be equity. Box 3 would be equity. This red sucks. Let me get that brown. You're either gonna have one box is asset, 2 box is liability, 3 box is equity, 4 box would be expense, 5 box would be revenue. Meaning anything that happens has to go. It has to either be an asset, it has to either be a liability, it has to either be an equity, it has to be an expense, or it has to be a revenue. It has to be one of those 5 categories. It has to be under one of those categories. Now, like under expenses, you might have, or under assets or under equity, not so much under equity, but under expenses, under liabilities, under any of these 5 categories, you might have 15 subcategories, like advertising, car and truck. These are all expenses. Advertising, car and truck, office expenses, supplies, computer, travel, telephone, computer expenses. All those expenses, all those would be under the expense category, under the expense chart of accounts. Sub expenses, I guess. But any transaction you have, anything you see, any transaction you have is going to be either in one of the 5 boxes. And then you figure out what it is, and there's two parts to every transaction. So you got to figure out what both parts are. That's what took me a while. That's what took me so much practice, because I always said there's 2 parts to it, but for the longest time I only saw one thing. So it's just going to take a lot of practice. A transaction you have to analyze, there's going to be 2 parts to it. One part is going to be a debit, and it's either going to be an asset a liability, an equity, an expense, or a revenue. The other part of it is going to be a credit, and that credit's either going to be an asset, a liability, an equity, an expense, or a revenue. So if you can just remember DC ADLER and write that down and work it and, you know, practice with it. Write DC ADLER down on your paper every morning for 2 months, and you will know it by heart. You will be so far advanced in your accounting, and you can thank me later. Come back to this video and thank me. Or come back to a video, you know, when you get your job, when you get your CPA license, when you graduate, come back and let me know. Because it does make me happy. It gives me life. Right, so you have a transaction. It's either going to be, it's either going to be an asset, it's either going to be a liability, it's going to be an equity, it's going to be an expense, or it's going to be a revenue. It's going to be one of those things. It's going to be one of those things, and it's either going to be a debit or a credit. Now, how would you know if it's a debit or a credit? Well, if it's, you know, if it's an asset, if it's going up, it's going to be a debit. If it's going down, it's going to be a credit. So on and so forth. So anyways, we'll see. This is definitely my longest video ever, but I feel like I have more, I feel like I'm not so frazzled. I haven't drank in about 9.5, 10 years, and when I first started making these videos, like 7 years ago, I had only not drank for like 2 years, and my attention span, I was doing so much caffeine. My mental health was horrible. I absolutely hated myself. I just feel like my mental health, my physical health is so good. I just feel like my mental clarity, I feel like, I don't know how long this video is going to be, like 30 minutes. I think my longest, I did like a 15 or 20 minute video before, but I mean, if you're here till this long, you might like it, but I'll just see. I'll probably mix and match shorter, longer videos, but thank you so much for watching the videos, leaving the positive comments. It really does mean a lot to me. It gives me purpose in my life. Sometimes I feel like I don't have purpose, and it's crazy how my biggest obstacles became my biggest strengths. Anyways, till next time, CPA Strength, I'm out. Deuces.